Imagine you spend like 30 years building a house.
Okay, I'm picturing it.
You lay every brick yourself, right? You sweat over the foundation. You're out there enduring storms, putting up the roof, and finally, it is finished. It's this beautiful, towering mansion.
Sounds pretty nice.
Right. You step back, you wipe the sweat off your brow, and you think, I did it. I'm safe. But what nobody told you is that the soil underneath is like slowly dissolving.
Oh, wow.
And the local zoning laws are about to change and demand you pay double the property tax.
Ouch.
Yeah. And to top it all off, there is a microscopic termite that only eats the very specific kind of wood you used for the support beams.
Well, that is a profoundly stressful visual to start us off with.
Try my best.
But honestly, it captures the exact psychological shift we're going to explore today. Because the mindset required to build that mansion is, completely different from the mindset required to keep it from collapsing.
Exactly. Welcome to today's deep dive. Today, we are taking a massive stack of source material, specifically the Schweizer 2025 Level 3 CFA Private Wealth Curriculum.
It is a dense one.
It really is. We are putting it under a microscope today, and our mission is to pull out the most critical insights about how to actually keep the wealth you have built.
Right.
Because, this curriculum is staggering. It basically attempts to map out the entire financial existence of a human being.
It does, yeah.
But we are setting aside the chapters on how wealth managers build their businesses, and we're setting aside the estate planning and family governance stuff.
We're zooming in.
Right. We are focusing intensely on reading W5, which is preserving the wealth. Because keeping your money safe from markets, inflation, and just the sheer randomness of the universe, it requires a very specific, almost aggressive kind of defense.
It requires a total paradigm shift, honestly. Preservation is not passive.
Right. It's not just sitting on cash.
Exactly. It is not taking your cash, stuffing it in a low-yield savings account, and, hoping for the best. Yeah. To the institutions and the top-tier wealth managers outlined in this text, wealth preservation is an active, highly strategic architectural process.
It's engineering.
It is. And I want to speak directly to you, the listener, right now. It really does not matter if you're overseeing a $50 million family office or if you are simply trying to rigorously protect your own 401k so you can retire in peace.
The concepts scale.
They do.
Yeah.
The institutional frameworks we are about to unpack scale up and they scale down. The math applies to you.
Okay, so let's get into that math. Because the very first thing the curriculum does is force you to completely redefine what your wealth actually is.
Right, from the ground up.
Yeah, it asks you to look in the mirror and view yourself, like your actual human life, as a corporate balance sheet.
And to accomplish that, the text uses a concept called the ALM framework, which is asset liability management.
Now, I usually hear ALM talked about in the context of giant commercial banks or pension funds, right?
It's typical institutional stuff, yeah.
Right. A bank has to make sure the long-term loans they issue, their assets, can generate enough cash to pay off the deposits that people might withdraw tomorrow, which are their liabilities.
Exactly.
But applying that to a single person, that feels wild.
It is a radical way to view a human life, but, it is incredibly effective for risk management.
How so?
Well, in the CFA framework, your financial health is ultimately defined by a single metric, and that is your surplus.
Okay, surplus.
Yeah, and your surplus is simply your assets minus your liabilities.
So everything I own minus everything I owe, or I guess will owe in the future.
Yes. A massive surplus acts as a shock absorber.
Like a financial airbag.
Right. If your surplus is huge, you can weather a catastrophic market crash or, a sudden medical emergency.
What if it's small?
If your surplus is razor thin, even a minor economic bump can just throw you into total ruin.
That makes sense.
But here's the kicker. To calculate those assets accurately, private wealth managers don't just look at your bank accounts or your stock portfolio or the equity in your home.
They don't.
They do, but they categorize all of that purely as financial capital. Then they add a second massive asset to your ledger, which is your human capital.
Okay, I want to spend some time here because the text defines human capital in a way that feels almost dystopian.
It's very clinical, yes.
I'll say. It defines human capital as the mortality-adjusted net present value of expected labor income.
It strips away all the romance of a career and just leaves only the math.
Wait, I really want to push back on this premise, though.
Go for it.
Treating myself like a bond with a default risk, isn't that ignoring, Career pivots, entrepreneurial upside, or just the fact that humans aren't static assets?
It's a common objection.
I mean, I am not a piece of government debt that just pays a fixed coupon. I can learn a new skill. I can start a business tomorrow.
That is a very natural human reaction to this framework. We like to think of our potential as limitless.
Right.
But from a strict risk management perspective, the wealth manager has to ground your potential in statistical probability.
Statistics ruin the fun again.
They always do. Yes, you could invent a brilliant new app tomorrow, but statistically, you are going to trade your time and skills for a relatively predictable stream of income over a set number of years.
Okay, fair enough.
By modeling you as a financial instrument, essentially a bond, the manager can quantify the risk you bring to your own balance sheet.
So I have a yield.
You have an expected yield, which is your salary. You have a maturity date, which is your retirement. And you have default risk.
Default risk meaning I get sick, I get disabled, or I die before I reach retirement age.
Exactly.
And I guess that is the mortality-adjusted part of that definition.
Precisely. And this is vital because your human capital must act as a counterbalance to your financial capital.
How did that balance work over time?
Well, think about when you are 25 years old. Your financial capital is likely close to zero.
Unfortunately, yes.
But your human capital is massive because you have, like, 40 years of expected earnings ahead of you.
So I am a very long-term bond at 25.
Right. And as you age, you essentially harvest that human capital, converting it paycheck by paycheck into financial capital.
I'm transferring it from one bucket to the other.
Yes. By the time you retire, your human capital bond matures. Its value drops to zero.
Because I'm not working anymore.
Exactly. And your financial capital has to take over the entire burden of funding your liabilities.
So not all human bonds are identical in this model, then?
Not at all.
Because the text specifically calls out that human capital is driven by earnings correlation, volatility, and replaceability. Let's break that down a bit.
Sure. Consider the risk profile of two completely different careers. Let's look at, say, a tenured university professor teaching medieval history.
Okay, very niche.
Very niche, but their income is incredibly stable. It is largely unaffected by the daily swings of the S&P 500.
Right, people still need to learn about knights and castles during a recession.
Yeah, exactly. Their risk of losing their job is microscopic. So in this ALM framework, that professor's human capital looks like a very safe, low-yield, government-backed bond.
Okay, now contrast that with an investment banker focusing on mergers and acquisitions.
A completely different financial instrument.
Totally.
The investment banker's bonus, which might make up 80% of their total compensation, is entirely dependent on corporate deal flow.
Which is highly tied to the stock market.
Highly correlated with equity markets, yes. Their income is incredibly volatile. They could make $3 million one year and literally be laid off the next.
Wow.
So their human capital behaves exactly like a high-yield, high-risk equity stock.
That implies a massive shift in how they should actually invest their money, doesn't it?
It dictates their entire strategy.
Because, I mean, if the investment banker's human capital is acting like a risky tech stock, and they invest all their actual financial capital in risky tech stocks, they're just doubling down on the exact same risk.
They are heavily, dangerously overexposed.
Because if the economy tanks,
they lose their job and their portfolio crashes simultaneously.
Double whammy.
Exactly. The ALM framework dictates that the investment banker should probably hold a much safer, bond-heavy investment portfolio to balance out their highly volatile human capital.
To smooth out the ride.
Yes. Conversely, the tenured professor, whose income is a rock-solid bond, has the capacity to take much more aggressive risks in the stock market with their financial capital. You have to manage the total picture.
That makes a lot of sense. You are managing the holistic ecosystem of your wealth, not just the brokerage account.
Precisely.
So how do we actually protect this ecosystem? Because the curriculum outlines a formal 5-step risk management process.
Identify, measure, evaluate, respond, and monitor.
Right. And I want to skip past the identification and measuring phases and really zero in on that response step, because this is where the action happens.
It's where the rubber meets the road.
The text categorizes our possible responses into 4 buckets. We've got avoidance, transfer, mitigation, and acceptance.
And these 4 responses are dictated by a very simple matrix.
How does the matrix work?
You look at every threat to your wealth, and you ask 2 questions. 1, what is the probability of this happening? And 2, what is the financial impact if it does happen?
Let me throw a scenario at you, directly inspired by the source material. I'm trying to work out how a professional manager actually applies this matrix in real time.
Okay, lay it on me.
Suppose I am facing a risk. The data tells me there is a very, very low probability of it occurring.
Right.
It might happen once in a lifetime, if ever.
Okay, low probability.
But if it does happen, the financial impact would be catastrophic. It would completely wipe out my surplus.
High impact.
Right. So which of those four responses is mathematically correct for that?
The mathematically correct response to a low probability, high impact risk is risk transfer.
Why? I mean, if it's a low probability, why not just accept it and hope for the best? Or mitigate it somehow?
Let's look at the other options to understand why transfer is really the only one that works here.
Okay.
If a risk is high probability and high impact, let's say free climbing, a sheer cliff face with no ropes.
The only correct response is avoidance. Do not do it.
Exactly. Do not do it. The cost of failure is absolute, and the chance of failure is way too high.
Okay, what about acceptance? When do I use that?
You use acceptance for low probability, low impact events.
Like what?
You buy coffee, you accidentally drop it on the sidewalk.
Tragic, but survivable.
Right. Low probability, low impact. You accept the loss of $5 and you move on. It is not worth the economic energy to ensure your latte.
And mitigation.
Mitigation is for high probability, low impact events.
Can you give an example?
Sure. If you park your car in a famously tight, cramped parking garage every single day, the probability of getting a door ding is very high.
Almost guaranteed.
But the impact is just a cosmetic scratch. You don't avoid the garage, and you definitely don't buy a massive insurance policy just for scratches.
You mitigate.
You mitigate, you install a rubber bumper guard, you reduce the impact.
So that leaves the low probability, high impact quadrant.
Think about your house burning down to the foundation.
The mansion from the intro.
Right. Statistically, the vast majority of homeowners will never experience a catastrophic fire. It is a very low probability event.
But if it happens to you, the financial impact is total ruin.
You lose your entire asset base overnight. You cannot simply accept a risk that bankrupts you.
Right, because you're wiped out.
And you cannot avoid it entirely because electrical faults happen, lightning strikes happen.
And mitigation, like smoke alarms.
Mitigation is crucial for saving your life, but a fire extinguisher won't stop a 3-alarm blaze from destroying the actual structure.
So I have to transfer the financial burden of that risk to someone else.
Exactly. You transfer it to a third party, an insurance company.
Yeah.
You agree to pay a small, known, highly manageable premium. And in exchange, the insurance company agrees to carry the catastrophic, unmanageable risk. That is the absolute essence of risk transfer.
So the goal of the working years is to manage that human capital, turn it into financial capital, and ruthlessly categorize every threat into those 4 buckets.
That's the playbook.
But what happens when the working years end? The human bond matures. The yield drops to 0.
But the bills keep coming.
Exactly. The liabilities, the property taxes, the grocery bills, the healthcare costs, they do not stop. We transition from building the surplus to draining it.
And this introduces what the curriculum defines as the longevity paradox.
The longevity paradox. I love that term.
It's fascinating. The ultimate goal of life is to survive, right? To live a long, healthy existence.
Of course.
But ironically, in the financial realm, extended survival introduces one of the most terrifying threats to your wealth, which is longevity risk.
The risk of outliving your money.
Yes.
It is a haunting concept. You do everything right. You save, you invest, but you just live too many years and the well runs dry while you are still thirsty.
It's a real fear for retirees.
And the text states that this risk is driven by 3 interlocking factors: time horizon, expected portfolio return, and withdrawal rate.
The interaction between those 3 factors completely determines your survival.
Let's start with time horizon.
Time horizon is perhaps the most heavily penalized variable if you miscalculate. Think about the cultural obsession with early retirement right now.
The FIRE movement, financial independence, retire early.
Exactly. If you choose to retire at 55 instead of 65, you have committed a double assault on your balance sheet.
A double assault.
First, you have eliminated 10 prime earning years where you could have been growing your surplus.
Right, those are usually high earning years.
Second, you have added 10 extra years of draining that surplus to cover your living expenses.
Oh, wow.
You are burning the financial candle from both ends, which radically spikes your longevity risk.
That makes the second factor, expected portfolio return, even more critical then.
It's foundational.
Because the text emphasizes that capital market assumptions are the bedrock here. If your wealth manager builds a plan, assuming your stocks and bonds will yield a 7% average return, but the market enters a stagnant decade, and only yields 4%.
Your capital is not replenishing itself fast enough to keep up with your withdrawals.
And that leads directly to the third factor, the withdrawal rate.
How aggressively are you siphoning capital out of the reservoir?
Right. If the market drops and you refuse to lower your withdrawal rate, you just accelerate the depletion.
Exactly. And when you combine these three factors, how long you live, what the market yields, and what you spend, you arrive at a metric that wealth managers use to really sober up their clients.
It's that.
It is called the probability of ruin.
The probability of ruin. It sounds so dramatic, but it is a cold, hard statistical output.
Very cold. Very hard.
It is the exact estimated mathematical likelihood that you will completely deplete your financial assets before you die, leaving you basically unable to meet your basic obligations.
To give this concept teeth, the CFA curriculum highlights a landmark study from 2005 by Milewski and Robinson.
Okay, what do they find?
They built a methodology that didn't just use simple averages. They approximated Monte Carlo simulations to simultaneously account for the unpredictability of financial markets and the biological uncertainty of human lifespan.
Let's spend some time on the actual data they published, because there is a table in the source material that maps this out, and it is fascinating.
Let's do it.
The table assumes the investor holds a standard 50-50 mix of equities and bonds. I want to walk through how an advisor actually uses this on a human being.
Paint the picture.
Let's say I am a 60-year-old investor. I just retired. I've accumulated exactly $5 million in financial capital.
Congratulations.
Thank you. Now I sit down across from you, my wealth manager, and I say, I am terrified of going broke. I want a 95% confidence level that my money will outlive me.
Okay, so in statistical terms, you are telling me you are only willing to accept a maximum 5% probability of ruin.
Right, a 5% chance I end up broke. So I am looking at the Milewski and Robinson table in the text. I go to the row for retirement age 60.
Yep.
Interestingly, the text notes the median expected age of death for this cohort is 83.4 years.
Which is important context.
Yeah. Now, I scan across the probabilities of ruin until I find the column that is closest to 5%. I see a cell that says 5.2% probability of ruin.
Okay, trace that up.
I track that up to the top of the column to see the corresponding withdrawal rate, and it says real annual spending based on $100 is $3.
That means for every $100 of capital you have, you can only spend $3 a year, a 3% withdrawal rate.
Okay, let me do the math on my $5 million portfolio. 3% of $5 million is exactly $150,000.
There's your number.
So, to maintain that ironclad 95% safety shield against ruin, my absolute maximum annual withdrawal limit is $150 grand.
Not a penny more.
If I decide I want to live a little larger and pull out $250,000 a year, I am blowing past that 3% rate, and my probability of ruin doesn't just inch up, it skyrockets.
It accelerates exponentially. But as a wealth manager, I have to look under the hood of that 5.2% number.
What do you mean?
How did the models actually generate that probability? Because the curriculum draws a massive line in the sand between two different analytical approaches.
Right, static mortality tables versus Monte Carlo analysis.
Exactly.
Mortality tables are what the government uses, right?
Yeah.
Like when the IRS calculates your required minimum distributions, your RMDs for your retirement accounts once you hit your 70s.
Yes. The IRS relies on static mortality tables. It is a very rigid, one-dimensional look at life.
How so?
The table simply says, you are 73 years old. The average person in your cohort lives to 86. Therefore, we assume you have 13 years left, and you must withdraw this exact fraction of your account this year.
So it's just a straight line.
It assumes a fixed lifespan. It usually assumes a flat, risk-free rate of return, and it completely ignores the chaotic reality of market volatility.
It plans for the average, but nobody actually lives the exact average.
Exactly. Nobody is perfectly average. That is why the curriculum strongly argues that Monte Carlo analysis is the superior institutional tool for wealth preservation.
Because it runs multiple simulations, right?
Right. A Monte Carlo simulation doesn't run one scenario. It runs thousands, sometimes tens of thousands of randomized simulated lifetimes.
So it throws everything at you.
It stress tests your portfolio against periods of high inflation, terrible market timing, and longer than expected lifespans all simultaneously.
Okay, but this is where I really need to stop you.
What's up?
Because I am reading the text's warnings about Monte Carlo, and it brings up a statistical flaw that feels huge. A Monte Carlo simulation is only as good as the assumptions you program into it.
Right. Garbage in, garbage out. Yes.
Right. So if you program it to simulate stock market returns, it usually relies on a normal distribution, a standard bell curve.
That is the default for many basic programs.
Right, where most years cluster around the average return in the middle, and extreme highs or extreme lows taper off symmetrically on the sides.
The standard 68, 95, 99.7 rule.
Yeah. 68% of returns fall within one standard deviation, 95% within two, and 99.7% within three.
And you are identifying the exact vulnerability the Schweizer text warns about.
Okay, so I'm not crazy.
Not at all. If a wealth manager blindly plugs a perfect symmetrical bell curve into a Monte Carlo simulation for equity returns, they are committing a dangerous error.
Why? Does the stock market not follow a bell curve?
Historically, absolutely not.
Not at all.
The text uses two very specific statistical terms to describe how actual securities returns deviate from a normal distribution. It says historical returns exhibit negative skew and positive excess kurtosis.
Okay, let's translate that out of the textbook and into reality.
Yeah.
What does negative skew and positive excess kurtosis actually mean for my $150,000 withdrawal rate?
Let's visualize the bell curve again.
Okay, got it.
Negative skew means the curve is not perfectly symmetrical. The left side of the curve, the side that represents market losses, negative returns, that side is stretched out longer than the right side.
Oh, I see.
There's an old Wall Street saying, the market tends to take the stairs up, but the elevator down.
So drops are faster and more violent than gains.
Yes. And positive excess kurtosis refers to the tails of that curve.
The tails being the extreme edges.
Right. The extreme edges where the rarest events happen. In a normal distribution, those tails are very thin. But in the real stock market, those tails are fat.
Fat tails.
Meaning extreme outlier events, massive catastrophic market crashes happen far more frequently in reality than a perfect bell curve would ever predict.
We're talking about black swan events.
Exactly. Think about Black Monday in 1987, where the Dow dropped over 22% in a single day.
Or the 2008 financial crisis.
Right. Or the liquidity crash in March 2020.
Yeah.
If your Monte Carlo simulation uses a normal distribution, it looks at those events and says, those are 5 standard deviation events. They should only happen once every 10,000 years.
They happen like once a decade.
Exactly. So the standard simulation basically ignores them.
Oh, wow. I see. If the simulation ignores the likelihood of a massive crash, it paints a much rosier picture of my survival.
It's wildly optimistic.
It might run 10,000 simulations and tell me good news. You can actually safely withdraw $200,000 a year with only a 5% chance of ruin.
But it's lying to you.
Because it hasn't factored in the reality of fat tails.
It is providing false confidence. If you retire, start pulling out $200 grand a year, and immediately get hit by a 2008-style fat tail event, your portfolio experiences a massive drawdown.
And because I'm still pulling out cash.
Because you are still pulling out cash while the portfolio is down, you permanently destroy capital that can never recover. Your real-world probability of ruin jumps to 50%.
That is terrifying.
This is why the curriculum insists that institutional Monte Carlo analysis must incorporate expected asset returns that reflect this real-world negative skewness and kurtosis.
It makes the models more conservative.
It forces withdrawal rates down.
Right.
But it is the only mathematical way to genuinely protect the wealth against the reality of the markets.
That is a phenomenal breakdown. It is the difference between planning for a theoretical, idealized world versus planning for the messy, fat-tailed world we actually live in.
Perfectly said.
So we have mapped out the statistical danger of outliving our money. But we need to pivot to a different kind of breakdown.
Okay, where to next?
We just assumed the human machine makes it to 83.4 years old. But what if the machine, your body, your ability to work, breaks down prematurely?
Before you even reach retirement.
Right. We are now moving fully into the risk transfer response strategy. We have to bulletproof the human machine using insurance.
And the text structures this by looking at specific failure points, starting with health and disability risk.
Health risk being the financial exposure to unexpected injuries or illnesses. And the curriculum makes a very deliberate distinction here between direct costs and indirect costs.
This is a crucial distinction. The direct costs are what most people think of when they buy health insurance.
The hospital bills.
The hospital room, the surgical fees, the MRI scans, the prescription drugs, the actual invoices generated by the medical system.
Right.
But from a wealth preservation standpoint, the indirect costs are often the ones that completely obliterate a family's ALM surplus.
You are talking about the loss of the yield, The disruption to the human capital bond.
Precisely. If a primary breadwinner requires aggressive chemotherapy for a year, their direct medical costs might be capped by their health insurance out-of-pocket maximum.
Like maybe 10 grand or something.
Right. But their indirect costs, the fact that they cannot work at full capacity or at all for 12 months, means their human capital yield drops to zero.
And the bills don't care?
The liabilities, the mortgage, the tuition, the groceries remain entirely unchanged. This gap between zero income and ongoing liabilities is what drains the financial capital surplus dry.
And this leads directly into disability risk.
Yes, the hedge against that indirect cost.
The text defines disability as an injury or illness that inhibits continuous employment. But it points out something fascinating about how disability insurance actually functions in the real world.
The fine print.
It all comes down to how the specific policy defines the word disability.
The definition is everything. The text highlights that policies generally fall into one of 3 tiers of definition.
Let's go through them.
The strictest, most difficult policy to claim against defines disability as the inability to work in any occupation.
Any occupation?
Yes. So if you are a neurosurgeon who loses the fine motor control in your hands, but you are still physically capable of being like a greeter at a retail store, this policy might deny your claim.
Because you can technically still work in some capacity.
Right.
That is terrifying. You lose a $3 million income, but you don't get a payout because you can technically earn minimum wage.
Exactly. The next tier defines disability as the inability to perform tasks aligned with your specific education, training, and experience. It's broader.
But not the best.
No, the gold standard, the most expensive and protective policy, defines disability as the inability to complete the specific tasks related to your current regular occupation.
An own occupation policy.
Under an own occupation policy, our neurosurgeon gets the full payout because they can no longer perform the exact job they were doing, regardless of whether they could teach or consult.
So for high net worth individuals, ensuring they have own occupation coverage is a critical pillar of risk transfer.
Absolute necessity.
The curriculum also flags another health-related risk that I think acts as a silent killer of wealth, especially later in life, and that's long-term care.
Long-term care is distinct from standard medical care. It is not about curing an illness. It is about providing continuous support for daily living activities.
Like bathing, dressing, eating.
Right, usually due to cognitive decline, like Alzheimer's, or just advanced physical frailty.
The detail that really jumped out at me in the text is the inflation rate associated with long-term care.
It's aggressive.
It states that long-term care costs generally rise at a pace that vastly exceeds standard economic inflation.
This is a classic modeling trap. If a wealth manager projects a client's future long-term care needs using the standard 3% general inflation rate, that client will be woefully underfunded when they actually need to enter a facility in 25 years.
Because the costs rise so much faster.
The cost of specialized medical labor in dedicated facilities compounds at a much higher rate. If you don't transfer this risk via long-term care insurance or overfund your surplus specifically to accept it, it will cannibalize the wealth intended for the next generation.
Okay, so we've covered the machine breaking down while it is still alive. But we must address the ultimate failure of the human bond, which is premature death.
The worst-case scenario.
The wage earner dies before the surplus is fully funded. The mechanism for transferring this risk is life insurance.
Life insurance serves a very specific mathematical function in the ALM framework. It is a direct hedge against the sudden, permanent evaporation of a family's expected human capital yield.
And the curriculum provides 2 distinct methodologies for sizing that hedge. How do you calculate exactly how much life insurance a person needs?
Right, there's a formula.
There is the human life value method and the needs analysis method.
The human life value method is what we classify as an asset-based approach. It looks squarely at the deceased as an economic engine.
Okay, walk me through the math on that.
It calculates the net present value of all the after-tax income you were expected to earn for the rest of your career.
Right.
Then, crucially, it subtracts the projected living expenses that you, the deceased, would have consumed yourself.
Because you don't need to feed or clothe the wage earner anymore.
Exactly. The remaining figure is the net financial worth that your continued existence would have provided to the family. That is the size of the insurance policy you buy.
It is incredibly clinical. Here is the net present value of my economic output.
Very cold.
But the second method, the needs analysis method, flips the perspective completely. It is a liability-based approach.
Yes. Instead of looking backward at what the asset would have produced, it looks forward at what the remaining family will actually need to consume.
How does it calculate that?
It calculates the present value of two separate buckets of liabilities. First, the short-term, immediate cash needs triggered by the death itself.
Like funeral expenses, medical bills.
And often, the strategic decision to immediately pay off large debts like the primary mortgage to reduce the family's ongoing burden.
And the second bucket.
The second bucket is the present value of the ongoing living expenses for the surviving family members for the rest of their expected lives.
Got it.
You calculate those total future liabilities, you subtract whatever current financial capital the family already has saved, and the shortfall is the amount of life insurance required.
It is a profound philosophical difference. Do you insure your intrinsic economic value, or do you insure your family's specific lifestyle needs? Once you determine the size of the hedge, say it's $3 million, the text moves on to the instruments themselves. It divides life insurance into two main camps: term and permanent.
The two big buckets.
Let me try an analogy here, because I think the standard renting versus buying a house metaphor is a little tired.
I agree. Let's hear a new one.
Okay. Imagine you are a merchant in the ancient world, and you have to transport a massive caravan of gold through a highly dangerous, bandit-filled forest. The journey will take exactly 20 days.
Okay, I'm like you.
Term life insurance is like hiring an elite company of mercenary guards. You pay them a set fee every single day. They surround your caravan, and if bandits attack during those 20 days, the mercenaries fight them off and protect the gold.
They provide pure risk protection.
Right. But if you make it out of the forest on day 21 without ever being attacked, the contract ends. The mercenaries go home, you don't get any of your fee back, you survived, but you have no lingering asset to show for the money you spent on security.
That is an excellent visualization of term insurance. It is temporary, it covers a specific period of high vulnerability, like when your children are young and your mortgage is high, and it is relatively inexpensive.
Because the insurance company knows that statistically, you will likely make it out of the forest alive, and they will never have to pay out.
Exactly. Now, permanent life insurance, which includes things like whole life or universal life, is totally different.
How would you fit that into the analogy?
Instead of hiring temporary mercenaries to cross a forest, permanent insurance is like building a massive, fortified castle on a piece of land you own.
Okay, I like this.
You are going to pay significantly more money up front to build those stone walls. The premiums are much higher.
Right.
But here is the mechanism that changes everything. Part of your premium pays for the guards on the walls, the mortality risk, but the rest of your premium goes toward building the actual stone infrastructure.
The castle itself.
That infrastructure represents the cash value of the policy. Over time, that castle builds intrinsic equity. Eventually, the castle is fully self-sustaining.
And you can borrow against it.
Yes. And because it is permanent, the insurance company knows they will absolutely have to pay out the death benefit eventually because everyone dies. But in the meantime, you own a structural asset.
The castle analogy perfectly captures the dual nature of permanent insurance. It is a blend of a mortality hedge and a tax-advantaged savings vehicle.
Exactly.
Okay, so life insurance hedges against dying too early. But we talked about the longevity paradox earlier, living too long. Is there an insurance product that transfers the risk of living to 104?
Yes. If life insurance pays a lump sum when you die, an annuity pays a steady stream of income for as long as you live.
So it's like reverse life insurance.
Pretty much. You are taking your longevity risk and transferring it entirely to the balance sheet of a major insurance conglomerate.
What is the mechanism of that transfer?
You hand the insurance company a large lump sum of your financial capital. In exchange, they sign a contract guaranteeing you a specific monthly payout for the rest of your natural life.
So if I die 3 years later?
The insurance company keeps the remainder of your lump sum. They win the bet.
Ouch.
But if you live to be 110, the insurance company must continue paying you every single month long after your original premium has been exhausted. They lose the bet, but you are protected from ruin.
But the curriculum is very clear about the core trade-off here.
There's always a trade-off.
By purchasing an annuity, you are buying certainty, but you are sacrificing legacy. The text notes that relying heavily on annuities can lead to lower overall lifetime income compared to a perfectly timed market portfolio, and it drastically reduces the wealth you leave behind for your heirs.
You are trading generational wealth for psychological peace of mind.
And the text mentions variations on this tool. There are SPIAs, single premium immediate annuities where you hand over the cash and the monthly checks start the very next month.
Right.
But there are also ALDAs, advanced life deferred annuities. How do those work?
With an ALDA, you might buy the policy when you retire at 65, but the contract stipulates that payouts do not begin until you reach an advanced age, say 85.
Why would I wait 20 years?
It is significantly cheaper to buy because the insurer has 20 years to invest your premium and a high probability you might pass away before it ever triggers. It acts as pure, deep-tail longevity insurance.
It protects against the extreme end of the mortality curve.
Exactly.
There's one final risk in this section we have to cover to fully bulletproof the human machine. We've protected the health, the lifespan, and the mortality. But what about legal exposure? The text dives into liability risk.
Liability risk is the financial threat of being held legally responsible for causing property damage or bodily harm to another person. It is the lawsuit risk.
So getting sued.
Yes.
Yeah.
You cause a severe multi-car pileup, or a guest suffers a traumatic brain injury falling down the stairs at your home.
Most people assume their standard home and auto insurance covers this. But the text explicitly points out the necessity of personal umbrella liability policies for high net worth individuals. Why?
Because standard policies have strict, relatively low payout limits. Let's say you are a successful executive with a surplus of $4 million. You cause a catastrophic accident and a jury awards the victim $3 million for lifetime medical care.
Oh.
Your standard auto insurance policy might max out at $500,000 of bodily injury coverage.
So the auto insurance company cuts a check for $500K and washes their hands of this situation.
Right.
Where does the remaining $2.5 million come from?
It comes directly from your ALM surplus.
Wow.
The courts will liquidate your taxable investment accounts, force the sale of secondary properties, and potentially garnish your future human capital earnings to satisfy the judgment.
So it destroys everything.
An umbrella policy is designed to sit on top of your underlying policies. If the auto insurance stops at $500,000, the umbrella policy immediately catches the overflow, covering the remaining $2.5 million.
It provides a massive, inexpensive legal shield.
It prevents a single accident from annihilating decades of wealth accumulation.
Okay, let's take a breath and look at the architecture we've built.
It's a strong fortress.
It really is. We have defined our human capital. We have run the Monte Carlo simulations with negative skew to protect against market crashes. We have built an insurance moat around our bodies, our lifespans, and our legal liabilities. The fortress is secure from external attacks. But as we turn to the next major concept in the curriculum, we realize we are facing an enemy that doesn't need to breach the walls. It is already inside the fortress.
The silent killer.
We have to protect the money itself against an invisible force that relentlessly erodes its structural integrity. We have to fight the silent thief, inflation.
Inflation is perhaps the most insidious threat to wealth preservation because it requires no catastrophic trigger. There's no car crash, no market collapse.
It just happens ambiently, day after day.
Right. The text defines inflation simply as the condition where price levels rise over time, which inherently reduces the purchasing power of a currency.
I want to tie this back to our ALM framework because the text makes a brilliant connection here. It states that inflation doesn't just erode the value of your assets. More dangerously, it increases the nominal value of your implicit liabilities.
Explain how you see that mechanism working.
An implicit liability is my future spending need. Let's say my lifestyle requires me to buy a certain basket of goods like groceries, energy, healthcare.
Okay.
If that basket costs $100,000 this year, that is my liability. But if inflation averages 4% over the next 2 decades, that exact same basket of goods will cost over $219,000 in 20 years.
It more than doubles.
Right. The underlying liability of my need to eat and stay warm has not changed at all. I'm not living a more lavish lifestyle. But the nominal cost to satisfy that liability has more than doubled. Therefore, my assets must grow at an aggressive rate just to tread water.
Just to stand still.
Exactly.
That is exactly right. You are running up a down escalator. And the curriculum categorizes the mechanics of this wealth erosion by identifying 3 distinct types of inflation.
Let's walk through them. First is demand pull inflation, right?
Yes. Demand pull. This occurs when aggregate consumer demand outpaces the economy's ability to supply goods and services. Too many dollars chasing too few goods.
Like during the pandemic recovery.
Exactly. When consumers had stimulus cash, but supply chains were frozen. Second is cost-push inflation. This happens from the supply side.
So it's not demand, it's the cost of making the stuff.
Right. The costs of production like raw materials, energy, or labor wages spike, and corporations push those increased costs directly onto the consumer to protect their profit margins. Think of the oil shocks in the 1970s.
And the third type, the text suggests this one is the most dangerous.
Unanchored inflation expectations. This moves from economics into pure psychology.
Psychology, how?
This is when the public fundamentally loses faith in the currency's stability. People just expect prices to go up every month.
So it becomes a self-fulfilling prophecy.
Exactly. Because they expect prices to rise, workers demand constant wage increases. Because wages go up, companies immediately raise prices to cover the payroll, which proves to the workers that prices are rising, so they demand more wages.
It's spiral.
It becomes a self-fulfilling, cyclical loop that is incredibly difficult for central banks to break without causing a severe recession.
Now, the text notes that wealthier investors are technically in a better position to absorb inflation because they have a larger surplus buffer.
Sure, they have more cushion.
But it also emphasizes that the mathematical drag on their portfolio's real return is profound. I want to actually demonstrate that mathematical drag. It's one thing to say inflation hurts. It's another to sit down and do the math.
Let's run the numbers.
The source material provides a scenario that really drives this home.
Okay.
Here is this setup. Let's say you are an investor and you have a great year. Your portfolio generates an 8% nominal return.
Very solid year.
You feel fantastic. But you have to pay a 20% capital gains tax rate on those earnings. And the broader economy is experiencing a 3% inflation rate. The question the CFA curriculum asks is, what is your actual real return? How much did your purchasing power actually increase?
I will walk through the formula the text provides. It is a two-step process. First, we have to calculate the after-tax nominal return.
Okay, so applying the taxes first.
You earned 8%, but the government takes 20% of that gain. So you keep 80% of the return. Mathematically, that is 0.08 multiplied by 1 minus 0.20.
Which gives us 0.064. So my 8% return is actually a 6.4% after-tax return.
Exactly. So the tax man already knocks your 8% down to 6.4, but we still have to account for the inflation termite.
Right. To strip out the inflation, we cannot just subtract 3% from 6.4%.
Right. No, you have to divide the wealth factors. We take our after-tax wealth factor, which is 1 plus that 0.064, giving us 1.064. We divide that by the inflation factor, which is 1 plus the 0.03 inflation rate, giving us 1.03.
Okay, let me do that calculation. 1.064 divided by 1.03, that equals 1.033, and then I subtract the 1 to get the percentage, which leaves 0.033, or 3.3%.
Exactly. Let that sink in. You saw an 8% gain on your brokerage statement.
Which felt great.
But after running the gauntlet of taxes and inflation, your actual ability to buy more goods, your real increase in purchasing power, was only 3.3%.
Over half of my perceived wealth generation was a mathematical illusion.
Yes, that is deeply sobering. So the obvious question is, how do we fight back? If stocks and bonds are getting eaten alive by this formula, what does a wealth manager buy to protect the surplus?
The text says we need assets that serve as natural inflation hedges, assets that have a positive correlation to inflation, meaning when inflation spikes, the asset's value spikes with it.
To find out what actually works, the curriculum looks at a massive set of historical data tracking asset performance from the year 1900 all the way to 2022.
122 years of data.
A very robust data set.
And the winner for the best inflation hedge might shock people. It wasn't buying gold bars and burying them in the yard.
No, it was commodity futures.
Based on that historical data set, commodity futures had the highest positive correlation to inflation of any major asset class at 0.21.
But here is a critical distinction the text makes. Commodity futures had a 0.21 correlation. But holding the spot commodities, like the actual physical barrels of oil or bushels of wheat,
only had a correlation of 0.10. The financial derivative was more than twice as effective at hedging inflation as the physical good. Why? What is the mechanism there?
It comes down to the mechanics of how futures contracts are structured and rolled over. When you invest in commodity futures, you aren't just getting the price movement of the underlying good. You are also capturing something called roll yield.
Roll yield. Explain how that works.
Futures contracts expire. If you want to maintain your investment in oil futures, you have to sell the contract expiring this month and buy the contract expiring next month.
Makes sense.
In certain market conditions, specifically when the market is in backwardation, meaning near-term prices are higher than future prices,
You are selling high and buying low every time you roll the contract over.
Exactly. This structural roll yield, combined with the collateral return on the cash used to back the margin, creates a return profile that historically tracks sudden inflationary shocks much more aggressively than just watching a pile of copper sit in a warehouse.
That is a phenomenal insight. The structure of the financial instrument provides the hedge, not just the metal itself. Now, I want to look at the other side of that data. What about international equities?
A lot of people fall into this trap.
Because a lot of people think if the U.S. dollar is experiencing inflation, I will just buy European or Japanese stocks. Diversifying globally will protect my domestic purchasing power.
It's a very common assumption, and the 122-year data completely destroys it.
It does.
From 1900 to 2022, international equities actually had a negative correlation to inflation of negligible 0.25.
A negative correlation, meaning when U.S. inflation spiked, international equities tended to drop. They did the exact opposite of what a hedge is supposed to do.
Yes.
Why does moving my money to Europe not protect me from U.S. inflation?
Because of the interconnected mechanics of global supply chains and currency valuation, high inflation often triggers central banks to aggressively raise interest rates to cool the economy.
And higher rates hurt stocks.
When rates rise, equity valuations globally tend to compress because the cost of capital becomes expensive. Furthermore, if the U.S. experiences high inflation, it exports that inflation globally through trade imbalances and currency dominance.
So it spreads.
An inflationary shock is rarely isolated. It acts as a drag on global corporate profits. So international stocks suffer right alongside domestic ones. They offer zero safe harbor from the inflation termite.
That is exactly why we do these deep dives. Intuition says buy foreign stocks. The data says buy commodity futures. Okay, we have survived the silent thief of inflation. But what if your wealth preservation strategy requires you to physically or financially look beyond your own borders? We arrive at the final major concept in our journey today, the global web, where we have to navigate exchange rate risk.
Inflation erodes your currency from the inside. But if your life, your assets, or your family are spread across multiple international jurisdictions, you face the risk of your currency fluctuating against others.
Right.
Exchange rate risk is the vulnerability an individual faces due to the constant, unpredictable fluctuations in the rates at which one currency can be exchanged for another.
And the curriculum points out that ultra-high net worth families face an exponentially higher degree of this risk.
Because their lives are so global.
They might have a business generating revenue in U.S. dollars, a massive tax liability in euros, a vacation home in Swiss francs, and a mission to preserve their wealth across multiple generations in terms of real global purchasing power.
It creates a highly complex, multidimensional balance sheet. There is no single currency that will universally serve as a stable store of value under all geopolitical scenarios.
Not even the dollar.
Even the U.S. dollar, which acts as the global reserve currency, may face restrictions on usage or localized devaluation based on shifting global political climates. The text points out a natural imbalance. The universe of investable assets is not perfectly aligned with world GDP. You cannot just hold one currency and assume you are safe globally.
So what is the actual mechanical vulnerability here? The core risk is a mismatch, right?
Yes, a mismatch.
It is a mismatch between the currency you hold your assets in and the currency you are obligated to pay your liabilities in. I want to set up our final scenario today. This is adapted directly from a case study in the text, and I want to paint a vivid picture of it because it shows how easily a multimillionaire can accidentally expose themselves to a massive shortfall just by crossing a border.
Walk us through the scenario.
Imagine you are a highly successful European executive. You currently live in Paris. You have accumulated exactly 2 million euros in liquid financial capital.
Going very well.
You feel very secure. However, you have decided that next year you are retiring and moving to London to be closer to your grandchildren. You have rigorously calculated your future ALM liabilities, buying a flat in Mayfair, paying UK taxes, ongoing living expenses, and you have determined that your future liabilities equal exactly 5 million British pounds.
Okay, so we have the future liability.
Today you check the exchange rate, and the market is trading at 0.85 British pounds for every 1 euro.
Okay, we have our variables, assets in euros, liabilities in pounds, and a specific exchange rate.
My question to you, the wealth manager, is, Where do I stand? What is my actual vulnerability right now?
To see the danger, we have to translate your entire ALM balance sheet into a single currency, the currency of your liabilities, the British pound.
Let's convert my assets.
You have 2 million euros. The exchange rate is 0.85. So we multiply 2 million by 0.85. That gives us 1.7 million British pounds.
Okay. My life savings of 2 million euros is currently worth 1.7 million British pounds.
Correct. But your future liabilities in London are 5 million pounds. Your translated assets of 1.7 million are vastly dwarfed by your liabilities of 5 million. In the strict terminology of finance, you are heavily short pounds and long euros.
Let's define that clearly for the listener, because short and long can be confusing outside of stock trading.
Sure.
Being short a currency in this ALM context means you desperately need it, you owe it, your liabilities are denominated in it. Being long a currency means you hold it, your assets are denominated in it.
Exactly. You are holding euros, so you are long euros. But you desperately need pounds, you are short pounds, to pay your future bills. And the exposed gap between those two positions is your exchange rate risk.
Let me do the math. You need 5 million pounds, you only have 1.7 million. That leaves an exposed shortfall of 3.3 million British pounds.
3.3 million pounds of pure, unhedged exposure. Put yourself in that executive's shoes. Imagine waking up tomorrow and the European Central Bank makes a surprise announcement that weakens the euro. The exchange rate drops from 0.85 to 0.75.
Without me doing anything.
Instantly, without you spending a single dime, your 2 million euros are now only worth 1.5 million pounds. Your shortfall just widened by 200,000 pounds in a single afternoon.
That's devastating.
Your retirement in London is suddenly mathematically impossible purely due to a central bank policy decision you had absolute no control over. That is the devastating power of exchange rate risk.
It is terrifying because it is entirely disconnected from your personal financial discipline. You saved the money, but the ruler used to measure the money changed overnight.
Exactly.
So how do we fix this? What are the actual mitigation strategies a wealth manager deploys to neutralize this gap?
The curriculum outlines several tactical approaches. First, there is passive hedging.
How does that work?
This is typically used for short-term and medium-term coverage. A manager will use forward contracts or currency futures to lock in an exchange rate today for a transaction they know is going to happen in 6 months. It eliminates the volatility, but it can be expensive to constantly roll those contracts over.
What about discretionary hedging?
Discretionary hedging allows the manager to express a market view. Instead of hedging 100% of the exposure, the manager might let the hedge ratio float between 50% and 100% based on their macroeconomic analysis of where the currencies are heading.
So it's more active.
It introduces human error, but it can capture upside if the currency moves in your favor.
Are there other strategies?
The text also mentions carry trade strategies, where you borrow in a low interest rate currency to invest in a high interest rate currency, but it heavily warns that carry trades are incredibly dangerous and prone to spectacular blowups during liquidity crises.
But the text also points out a remarkably simple structural solution that doesn't rely on financial derivatives, doesn't it? Natural hedging.
Yes. Sometimes the most robust solution is the simplest. If you have a massive liability in British pounds, the most effective natural hedge is to change the denomination of your investments.
Move the assets.
You take your 2 million euros, you convert them today, and you invest them directly into assets that are priced in British pounds, like UK government gilts or London real estate.
By matching the currency of the asset directly to the currency of the liability, you completely bypass the exchange rate.
You eliminate the risk entirely for that portion of your wealth. 1 pound of asset will always equal 1 pound of liability, regardless of what the euro does.
But what if the situation is even more complex? What if you are a truly global family?
It gets tricky.
Because you have business operations in the U.S., so you have dollar liabilities. You have a massive tax bill coming due in France, so you have euro liabilities. And your children are attending university in the U.K., so you have pound liabilities. How do you hedge a web that complicated?
For multi-jurisdictional families, the text suggests using a customized currency basket index.
How does a customized basket actually function?
It acts as an overarching, highly disciplined mathematical overlay. The wealth manager audits your entire global ALM balance sheet. They calculate that 50% of your future liabilities are in US dollars, 30% are in euros, and 20% are in British pounds.
So they map it all out.
Right. They then construct a specific currency hedge using derivatives that mimics that exact 50, 30, 20 weighting.
It's like building a bespoke index fund just for your family's specific global footprint.
Exactly. And the profound advantage of this, as the text knows, is that it provides a systematic, non-disruptive defense. It separates the currency decision from the investment decision.
That makes sense.
You can keep your brilliant stock pickers in New York buying U.S. equities and your bond managers in Paris buying European debt, letting them do what they do best. Meanwhile, the customized currency overlay quietly runs in the background, continuously rebalancing the global scales and neutralizing the exchange rate risk.
It is the ultimate architectural defense. It ensures that no matter where in the world the wealth was created, it speaks the exact right language when it comes time to pay the bills. Let's step back and pull all of this together. Let's synthesize the massive journey we have been on today through Reading W5.
We covered a lot of ground.
We did. We started by radically reframing how you view your own existence. We discarded the romantic view of a career and learned to treat your human capital as a mortality-adjusted bond that must be meticulously balanced against your financial capital using an asset-liability management framework.
Building the foundation.
We mapped out the exact statistical probability of ruin. We saw why outliving your money is a mathematical paradox. And we proved exactly why Monte Carlo simulations must incorporate the negative skew and fat tails of real-world market crashes, or else they will lie to you about your safe withdrawal rate.
The fat tails always get you.
We built a fortress of insurance around the human machine. We learned the difference between direct and indirect health costs, the danger of long-term care inflation. And we used the human life value and needs analysis methods to calculate exactly how much mortar we need for our life insurance council. We transferred our longevity risk to annuities and shielded our surplus from the courts with umbrella liability policies.
A fully bulletproofed plan.
We learned the mathematical formula for how the silent thief of inflation erodes real returns, discovering that historically, the structure of commodity futures provided the best shield, while international equities offered none. And finally, we navigated the global web, learning how to identify exchange rate risk when your liabilities cross borders, and how to neutralize it using natural hedging and customized currency baskets.
When you look at it all laid out like that, the core thesis of the CFA curriculum becomes undeniable.
Which is?
What does this all mean for the listener? It means that hope is not a wealth preservation strategy. Treating your financial life with the rigor of an institution requires shifting from a passive state to an active state.
Right.
Asset liability management isn't just for massive pension funds. It is for anyone who wants to mathematically guarantee that their money outlives them rather than the other way around. You have to methodically identify, measure, evaluate, and transfer the risks that threaten to bring the mansion down.
Preservation is an active, daily discipline. We've covered a staggering amount of ground today navigating these diagnostic muddy waters. But I want to leave you with a final, slightly provocative thought to mull over as you review your own balance sheet tonight.
Oh, I like these.
We spent a lot of time today talking about mortality tables, longevity risk, and the danger of living to 85 or 90. But the models we discussed are based on historical human biology.
True.
Imagine if tomorrow, a massive medical breakthrough like cellular rejuvenation or advanced nanotechnology pushes the average human lifespan not just to 90, but to 120.
Wow.
If your human capital bond suddenly has 40 extra years of liability attached to it, but you are physically, technologically, or legally too old to work those extra 4 decades.
That changes everything.
How would that fundamentally break our current models of wealth preservation? If a 3% withdrawal rate protects you for 30 years, what rate protects you for 60 years of retirement? The math we rely on today might not survive the medicine of tomorrow. The rules of preservation might have to be rewritten entirely.
That is a fascinating thing to think about.
Something to mull over as you inspect the foundations of your own financial house. Until next time, keep diving deep.